You probably think you know exactly how much dividend income $100,000 will generate. Most people do some quick math in their head, assume a decent dividend yield, and figure they've got it all worked out. But here's the thing that might completely change how you think about dividend investing. The actual income you'll receive from that $100,000 could be dramatically different from what you're expecting, and understanding why could be the difference between building real wealth and staying stuck in mediocrity. And I help people understand how smart money decisions today create financial freedom tomorrow. If you're serious about building wealth through dividend investing, make sure to subscribe to the channel and hit the like button if this information helps you see things differently. Let me start with a question that reveals how most people think about dividend income. If I told you that a $100,000 investment could generate anywhere from $500 to $7,000 per year in dividends, which number would you immediately assume is realistic? Most people gravitate toward the higher number because it sounds more exciting and fits their expectations of what investing should deliver, but that assumption could cost you serious money over the long term. The truth is, both numbers are completely realistic depending on your strategy, but here's what nobody tells you about the relationship between dividend yield and total returns. It's not what you think. And it's definitely not what the financial media wants you to believe. There's an inverse relationship at play that most investors completely ignore, and it changes everything about how you should approach dividend investing. Before we dive into the specific numbers, let me ask you something else. When you picture dividend income, what comes to mind? Maybe you imagine checks arriving in your mailbox every month, providing steady cash flow that covers your expenses while you sip coffee on your porch. Perhaps you envision dividends funding your retirement lifestyle or paying for your kids' college tuition. These mental images are powerful and they drive a lot of investment decisions, but they might be leading you down the wrong path entirely. Here's where things get interesting, and this is something that even experienced investors often misunderstand. The amount of dividend income your $100,000 generates has almost nothing to do with how much money you'll actually have in the future. I know that sounds counterintuitive, especially when every dividend investing guru on social media is showing you their monthly dividend payments like they've discovered the secret to financial freedom. Let me explain what's really happening with three different scenarios, each using that same $100,000 investment. The differences in outcome might shock you, and they'll definitely change how you think about structuring your portfolio. Scenario 1 involves investing your entire $100,000 into a broad market index fund that tracks the S&P 500. Right now, you'd be looking at approximately $1,500 per year in dividend income. That breaks down to about $125 per month, or roughly $375 every quarter when those payments actually hit your account, right? Not exactly enough to quit your day job, but it's something. Here's what most people miss about this approach. While that dividend yield sits around 1.5%, the total return from this investment historically averages about 10% annually. That means the vast majority of your wealth building comes from capital appreciation, not dividend payments. Your shares are growing in value much faster than the dividends are accumulating, which is actually fantastic news for your long-term wealth. But let's say you want more dividend income because those monthly payments feel more tangible and exciting. This leads us to scenario 2, where you might invest in companies specifically chosen for their high dividend yields. Take a company like Iron Mountain, which stores and manages information for businesses. It's actually a real estate investment trust, or EIT, which explains why it pays such an attractive dividend yield of about 7%. With your $100,000 invested in something like this, you'd receive $7,000 per year in dividend income. That's nearly $600 per month hitting your account, which sounds pretty appealing. You could probably cover a car payment, help with mortgage expenses, or build a nice vacation fund with that kind of cash flow. This is where a lot of investors get excited and think they've found the holy grail of passive income. But here's the part that might surprise you, and it's crucial to understand if you want to make smart investment decisions. Those higher dividend payments often come at a significant cost that isn't immediately obvious. Companies that pay extremely high dividends are typically mature businesses that aren't growing very quickly. They're essentially giving you back your own money instead of reinvesting it to grow the business and increase the share price. Think about it logically. If a company has incredible growth opportunities and can reinvest their profits to expand the business, increase market share, and boost future earnings, why would they give that money to shareholders as dividends? They wouldn't. They'd reinvest every dollar they could to fuel that growth, knowing it will create much more value in the long run. The companies paying those juicy 7% dividends are often in mature industries where growth opportunities are limited. They've essentially hit a wall in terms of expansion, so they return profits to shareholders because they can't find better uses for the money within their business. This isn't necessarily bad, but it does mean you're trading potential capital appreciation for current income. Now let's explore scenario 3, which involves investing in growth-focused companies within the S&P 500. These are typically technology companies like Apple, Microsoft, Google, and Tesla. If you put your $100,000 into a fund focused on these types of businesses, your dividend yield might only be around 0.5%. That means just $500 per year, or roughly $41 per month in dividend income. At first glance, this seems like a terrible deal. You're getting less than 1/10 the dividend income compared to our high yield example, but here's where understanding the bigger picture becomes absolutely critical to your financial success. Gary's, these growth companies are reinvesting their profits back into research and development, expanding into new markets, and building competitive advantages that will drive massive increases in their stock prices over time. The dividend payments might be tiny, but the total return potential is significantly higher. While you're receiving minimal cash flow today, your shares could be worth dramatically more in 5, 10, or 20 years, right? For younger investors who don't need immediate income, this approach often creates substantially more wealth over the long term. This brings us to one of the most important concepts in dividend investing that almost nobody talks about. The decision between high dividend yield and total return isn't just about investment strategy. It's about your personal financial timeline and what you're actually trying to accomplish with your money. If you're 25 years old and investing for retirement, chasing high dividend yields might be one of the worst strategies you could choose. You don't need income today. You need maximum wealth accumulation over the next 40 years. Every dollar you receive in dividends and spend instead of reinvesting is a dollar that isn't compounding and growing for your future self. On the other hand, if you're already retired and need your investments to generate income for living expenses, then higher dividend yields start to make more sense. But even then, focusing exclusively on dividend income without considering total return can be a costly mistake. Here's something that might blow your mind about dividend investing. The most successful dividend investors aren't necessarily the ones receiving the highest dividend payments. They're the ones who understand how to balance current income with long-term growth, and they know exactly when to prioritize each approach based on their financial situation and goals. There's another layer to this that most people completely overlook, and it's probably the most important piece of the entire puzzle. The power of dividend reinvestment can turn those seemingly small payments into something extraordinary over time, but only if you understand how to use it correctly. Let me paint you a picture that illustrates this perfectly. Imagine two investors, both starting with that same $100,000. Sarah decides she wants to see those dividend payments hit her bank account every quarter because it feels good to receive that cash. She takes her dividend payments and uses them for whatever she needs. Maybe it's a nice dinner out, a weekend getaway, or just extra spending money. Nothing wrong with that, right? Meanwhile, her friend Tom takes a completely different approach. Instead of spending his dividend payments, he automatically reinvests every penny back into buying more shares. It seems like such a small difference, but the long-term impact is absolutely staggering. After 20 years, Sarah's portfolio might be worth around $400,000, while Tom's could easily be worth over $600,000. Same starting amount, same investments, but that simple decision to reinvest dividends created an extra $200,000 in wealth. Here's where it gets even more interesting, and this is something that'll probably make you rethink everything you thought you knew about dividend investing. The companies that consistently increase their dividend payments year after year often end up being the best total return investments as well. It sounds backwards, but stay with me on this. Think about a company like Microsoft. 20 years ago, they were paying a tiny dividend that most income investors probably ignored. But they've increased that dividend payment every single year since then, and guess what happened to their stock price during that same period? It absolutely exploded. The dividend yield when you bought the stock 20 years ago might have been 1%, but because you held onto those shares, you're now earning a much higher yield on your original investment, plus you've seen massive capital appreciation. This is what dividend growth investing is really about, and it's why some of the smartest investors focus on companies with a track record of consistently raising their dividend payments rather than chasing the highest yields available today. A company that can afford to increase its dividend every year is telling you something important about the health and growth trajectory of their business. But here's the part that might make you laugh or maybe cry, depending on how you've been approaching dividend investing. Most people do exactly the opposite of what actually works. They see a stock yielding 8 or 9% and think they found some hidden gem that everyone else missed. Meanwhile, they ignore companies yielding 2% that have been increasing their payments for decades. It's like choosing a restaurant based solely on the size of their portions without considering whether the food actually tastes good or won't give you food poisoning. Sure, you might get more food for your money, but you're probably going to regret that decision later. The reality is that extremely high dividend yields are often warning signs, not opportunities. When a stock is yielding significantly more than its peers, it usually means one of two things is happening. Either the company is in financial trouble and investors are selling the stock, which mathematically increases the yield, or they're paying an unsustainable dividend that they'll eventually have to cut. When companies cut their dividends, two bad things happen simultaneously. The income you were counting on disappears, and the stock price typically plummets because dividend investors abandon the stock en masse. It's like getting hit by a financial double whammy that can take years to recover from. I've seen investors get absolutely crushed by this scenario, and it's completely avoidable if you understand what to look for. The key is focusing on companies that can comfortably afford their dividend payments and have room to increase them over time rather than stretching to pay the highest yield possible. Now, let's talk about something that most dividend investing content completely ignores, but it could dramatically impact your results. Taxes. Yeah, I know, everyone's favorite topic, right? But understanding the tax implications of dividend investing could save you thousands of dollars over time or cost you thousands if you get it wrong. Here's what most people don't realize. Not all dividend income is taxed the same way, and where you hold your dividend-paying investments can make a huge difference in how much money you actually get to keep. If you're holding dividend stocks in a regular taxable account, you're going to owe taxes on those payments every single year, whether you spend the money or reinvest it. But if those same investments are held in a tax-advantaged account like an IRA or 401k, you can reinvest those dividends without any immediate tax consequences. The difference in long-term wealth accumulation is enormous, especially when you're talking about decades of compounding growth. Think about it this way. If you're in a 22% tax bracket and receiving $2,000 per year in dividend income, you're immediately losing $440 to taxes. That's $440 that can't be reinvested and compounded over time. Over 20 or 30 years, that lost compounding opportunity could easily cost you tens of thousands of dollars in potential wealth. This is why understanding the bigger picture of dividend investing is so crucial. It's not just about finding stocks that pay dividends, it's about structuring your entire investment strategy to maximize your after-tax returns over your specific time horizon. Here's another angle that might surprise you about that $100,000 investment. The actual amount of dividend income you receive isn't just determined by your investment choices. It's also influenced by market conditions, economic cycles, and even the specific timing of when you invest your money. During periods of economic uncertainty, many companies reduce or eliminate their dividend payments to preserve cash. This happened on a massive scale during the 2020 pandemic when dozens of well-established dividend-paying companies cut their payments or suspended them entirely. Investors who were counting on that income for living expenses got a harsh reminder that dividends aren't guaranteed, no matter how reliable they might seem. On the flip side, during periods of economic growth and expansion, companies often increase their dividend payments more aggressively than usual. This means your dividend income from that same $100,000 could vary significantly depending on when you invest and what's happening in the broader economy. The smart approach is to view dividend income as one component of your overall investment returns, not as a guaranteed income stream that you can count on indefinitely. This perspective helps you make better decisions about how much dividend income you actually need versus how much total return you should be targeting for your specific situation. As we've explored these different scenarios and considerations, one thing should be becoming clear. The question of how much dividend income $100,000 will generate isn't really the right question to be asking. The better question is how to structure your investments to achieve your specific financial goals, whether that's maximizing long-term wealth, generating current income, or finding the optimal balance between the two. What's fascinating is how this all connects to something most investors never consider when they're crunching those dividend numbers. The psychological trap of dividend income. Yeah, you heard that right. There's actually a mental trick your brain plays on you that can sabotage your wealth building without you even realizing it's happening. Here's what I mean. When you see that quarterly dividend payment hit your account, your brain releases a little hit of dopamine. It feels like you're getting paid for doing absolutely nothing, which is incredibly satisfying. You start checking your account more frequently, maybe even planning how you'll spend that next payment. Before you know it, you're making investment decisions based on how good those dividend payments make you feel, rather than what will actually build the most wealth over time. This is why so many people get addicted to high dividend yields, even when the math clearly shows they'd be better off with growth investments. It's not about the numbers anymore. It's about the emotional satisfaction of seeing regular payments. Your brain starts treating dividend payments like salary from a job you don't actually have to show up for. But here's where it gets really interesting, and this might make you question everything you thought you knew about building wealth. The investors who end up with the most money often go through long periods where they receive very little dividend income at all. They're focused on accumulating assets that will generate massive cash flow later rather than trying to create income streams immediately. Think about it like planting an orchard. You could buy a bunch of small fruit trees that will give you a few apples this year, or you could plant saplings that won't produce anything for several years but will eventually become massive trees, generating tons of fruit for decades. Most people choose the small trees because they want apples today, but the smart money plants saplings and waits. This brings us to something that'll probably make you laugh at how backwards most dividend advice really is. The financial media loves to showcase retirees who are living off their dividend income, driving around in RVs funded by their stock portfolios. These stories are compelling because they paint a picture of financial freedom that feels achievable and tangible. But what they don't tell you is how these people actually built their wealth in the first place. Spoiler alert, it probably wasn't by chasing high dividend yields from day one. Most likely, they spent decades accumulating growth assets, then gradually shifted toward income-generating investments as they approached or entered retirement. The dividend income you see today is the result of smart wealth-building decisions made 20 or 30 years ago. Here's another reality check that might sting a little. If you're under 50 and you're obsessing over dividend yields, you're probably doing it wrong. I know that's harsh, but think about it logically. You've got decades for your money to compound and grow. Why would you prioritize getting small payments today when that same money could be turning into substantially larger amounts over time? It's like being offered a choice between receiving $5 every month for the next 30 years or receiving nothing for 29 years and then getting $10,000 in year 30. The monthly payments feel more satisfying psychologically, but the lump sum is obviously the better financial choice. Yet this is essentially the decision many young investors are making when they chase dividend income. So there you have it. That $100,000 could generate anywhere from $500 to $7,000 in dividends, but the real question isn't how much income you'll get today. It's how much wealth you'll have tomorrow. Stop chasing those shiny dividend payments and start thinking like someone who actually wants to get rich. Your future self will thank you for it.